Today, we're going to be talking all about fixed rates versus variable rates. You've found your perfect property and now it's come to getting your mortgage and you're wondering, okay, but what is a fixed rate and what is a variable rate? Well, stay tuned to find out more. Hello, welcome back to our channel and podcast. My name's Gemma and here at WIS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Iftikhar joining us once again. Ifti is a trained accountant and mortgage advisor who has been in the industry for over 10 years, and he is also one of the founding directors here at WIS. Hello, welcome back Ifti. How are you doing today?
I'm very well, thank you. How are you doing, Gemma?
Yes, I'm very good, thank you. So back again on another episode, and today we're talking all about fixed versus variable rates. So I think the best place for us to start is, what is a fixed rate mortgage?
Okay, cool. With fixed rate mortgages, this is the most popular one because what happens is usually with banks, they have something called a standard variable rate. That's the rate at which the banks lend out for mortgages to any customer. But with a fixed rate, you sign up for a deal with a bank for maybe 2 years, 3 years, or 5 years. Those are the most common ones. There are 10-year, 7-year mortgages as well, but those are the more common ones, the 2, 3s, and the 5s. So during that time period, even though the tenure might be, say, 25 years, during that deal period, the interest rate will be fixed. So if the bank says it's a 2% interest rate, irrespective of whether the Bank of England increases the rate or if the bank's standard variable goes up or down, your interest rate does not change. It will remain static for that period of time. So that's called a fixed rate mortgage.
Okay, and so can you now explain for everybody listening what is a variable rate mortgage?
So similar principles apply. So you might have a, say, 25-year tenure mortgage, but for that period, say a 2-year or a 3 years or a 5 years, you can also have a variable rate, which means it's not fixed. Right, it won't be exactly 2%. If you take something like a tracker product, it will be, say, Bank of England base rate plus, say, 2%. So let's say that's the rate. So if the Bank of England base rate changes, that changes along with that. So if it goes up, your interest rate will go up. If it goes down, your interest rate will go down. But for that deal period, say 2, 5 or 3 years, you will be on a variable rate. So that can vary from time to time. I mean, Bank of England, we don't know how often they change rates. They have been quite static probably for the last 1.5 years or so since the beginning of the pandemic. But these could change, right? So we don't really know. There's also another type of variable, which is the standard variable rate, which is the bank's variable rate. So if you're not on a deal, you are generally on a standard variable rate. So that too will vary from time to time. It can go up or down.
Standard variable, sometimes it's abbreviated to SVR, which you guys may have seen. But there are different types of variable mortgages. I know you just mentioned tracker, which is one of them. Maybe you could just talk us through what a tracker is and what the other ones are as well.
Yeah, there's about 4 types of variable rates. Tracker is the most popular one. So tracker tracks your rate against the Bank of England base rate, like I mentioned earlier. So currently Bank of England base rate stands at 0.1%. So if you have a deal, say 1% above Bank of England base rate, your rate will be 1.1%. So if the Bank of England, say tomorrow decides to change the rate to 0.25%, your interest rate will be 0.25 plus 1%. So that's how this tracker generally works. But then there are something called a discounted, which is also a type of a variable rate. Now, with a discounted rate mortgage, what happens is it doesn't track against the Bank of England base rate, but it tracks against the standard variable rate of the bank. So, for example, if the standard variable of X bank is 5%, and let's say you get a 3% discount, your discounted rate will be 2%. So if the bank, say 6 months down the line, decide to increase their standard variable to 5.5%, you get a 3% discount, your rate will move to 2.5. So it's not connected to the Bank of England base rate, but it is connected to the bank's standard variable rate. So that's the main difference between a discounted rate and a tracker product. So that's the second type of variable rate you find. And then you got, obviously, the standard variable rate is also a variable rate that you have. So the standard variable rate is generally associated with people who are outside a deal. So for example, let's say somebody took a 2-year deal and the deal finished, right? So when the deal finishes, you are automatically moved to a standard variable rate. So standard variable rates are normally more expensive than a deal, because obviously with a deal, bank gives you something special, right? But with the standard variable rate, they don't give you anything special. That's their normal rate. So that is also a type of variable rate that you find as well. And then you have variable rates with a cap, right? So these are not common, but you find those, because with a cap, what happens is, yes, it is variable, but it has an upper limit. So for example, let's say the variable rate is Bank of England base rate plus say 1% or standard variable rate plus 1%. If that rate goes up, there's an upper limit. So let's say this is connected to the standard variable rate. If the standard variable rate goes up by say 0.5%, and if the cap's at 0.5%, it stops there. It doesn't go beyond that. So if the standard variable rate goes up by 1%, it still stops at 0.5%. So that's a cap one. But that's not very popular. The ones which are popular at the moment is trackers. We find that loads and loads of lenders are coming up with discounted rates now. So that's becoming popular as well. But the cap ones are generally not very popular.
Yeah, okay, thanks, Sifty. Now, just going back to what we were saying about standard variable rates connected to the Bank of England base rate, could you just clarify, like, is that actually connected then? How does it work?
Technically, it's not, right? Standard variable rate is at the rate which bank generally lends out, but it's very much connected as well, because what we find is the last time the Bank of England reduced their base rate, the standard variable rates invariably went down as well. So technically, it's not connected, but we know that the Bank of England base rate can drive the standard variable rate. So it's quite connected in many ways, right? So yeah.
Okay. I've been hearing that there are a lot of discounted rates coming up on the market. What do you say about that then?
Yes, there are a lot of rates coming up in the market, and people are finding these quite a lot. We use the sourcing software to sort of find our deals, the best rates for the customers. But then when we look at it, at the moment, there are a lot of discounted rates which are showing up, and they are showing much cheaper than the fixed rates. We can see some trend building there. So hopefully we may see more and more discounted rates out there. What you're saying is correct, yeah.
Okay, and going back to a tracker mortgage, let's just maybe talk about the benefits of a tracker mortgage. What would you say to someone who was thinking about getting a tracker mortgage?
So the main benefit with a tracker mortgage is it tracks the Bank of England base rate. So if you think the Bank of England base rate will go down, or if it goes down, you will benefit from it, right? If you take an example, when the pandemic started, the Bank of England base rate was 0.75%. So the Chancellor made an announcement that it was dropping from 0.75% to 0.1%. People saw the benefit from that, because what happened was somebody was on a, say, 1% interest rate. It suddenly became 0.35%. So there was a massive drop for them. So you benefit from it if the Bank of England interest rate drops. But if you think the interest rate is going up, generally it's not the best deal to take. So if the trends in the market show that an upward trend, probably you want to stay away from trackers, because the rates may go up, right? Of course, fixed rates have its own merits and disbenefits as well, but you mainly benefit from a tracker if the interest rate goes down. The second main advantage you find with tracker products is most of the banks who offer tracker products offer it without an early repayment charge. Now, if you take a fixed rate mortgages generally has an early repayment charge. So, for example, let's say you took a 5-year deal, and after 3 years, you have to sell the house for some reason. If you have to sell the house, what usually happens is the bank will say, fine, you can settle the mortgage, but we were expecting you to be with us for 5 years. So because you broke the deal, you have to pay us a penalty. That's called an early repayment charge. So that early repayment charge, a lot of lenders who offer these variable tracker products do not charge an early repayment charge. So that's a massive benefit that people have with one of these tracker products. So those are the two main benefits you find with tracker products.
I know a few people might be wondering, because I know we just talked about discounted rates.
Yeah.
Do you have to pay an early repayment charge with discounted rates?
You got to look at the offer. Sometimes there are penalties associated with that as well. Most of the time there is, right? But it's very lender specific, because the whole idea of the discount is, okay, you're taking a deal, so we are giving you a discount, right? So if you don't stick to your part of the deal, very likely the bank will say, okay, you got to pay an early repayment charge. The main exception you find is with the tracker products. But with the discounted ones, generally there is one associated, but you got to look at specifics in your agreement, or if you haven't applied for a mortgage yet, you got to look at the key fact illustrations, or your broker will be able to help you with this as well. Yeah.
Yeah, thanks, Ifti. Now, I don't want to confuse anybody, but there is another kind of mortgage called a flexible fixed mortgage.
That's right.
Do you want to just talk us through that one?
Yeah, again, this is not very popular because not many lenders offer this product. So with a Flexfix, it is for all purposes, it's a fixed rate mortgage. But the beauty of it is you can break that mortgage without an early repayment charge.
Yes.
So that's why it's a Flexfix mortgage. So Flexfix mortgages are not offered by all lenders. There are a couple of lenders, as far as I know, who offer this, right? A couple of mainstream lenders. But what happens is it's popular because you can break it in between. So if somebody's thinking, okay, I'm going to move house in a year and they want to fix their mortgage, this might be a solution for them.
Yeah.
Because otherwise what happens is if you take a fixed rate, you have a penalty to pay. So this is kind of a hybrid between a tracker mortgage and fixed mortgage.
I feel like you get the
so
best of both worlds.
Best of both worlds, that's right. Yeah, that's a term I'd like to use as well, yes.
So, okay, if you were going to talk to somebody, why would you advise them to perhaps go for a fixed rate mortgage?
Okay, so fixed rate mortgages, generally people like fixed rate mortgages because people like certainty, people don't like uncertainty. Because with a tracker, if the Bank of England base rate changes, the interest rate goes up, right? So if you're on a budget and you know that, okay, I'm very happy to pay, say, £500 as a mortgage, and suddenly if it moves to 600 or 550, tomorrow you might not be ready for it and you may not have the money. So that's the main reason why people use a fixed rate mortgage. Also, it's kind of a peace of mind for people as well, right? Because they can sleep not worrying what their mortgage is going to be in 6 months' time, right? So people like that. For peace of mind, people take a fixed rate mortgage. And generally, you get some good deals with the fixed rate mortgages as well. It's the most popular one around anyway. So therefore, a lot of banks offer fixed rates. Some banks don't offer tracker mortgages. So it's quite popular. Those are the main advantages you find. So you find more and more deals with the fixers rather than the trackers, yes.
But I feel like it's kind of a little bit of a catch-22. I know people that are on 10-year fixed rate mortgages, and although that, like you said, for those who like to plan and stuff, it can be a good thing, but maybe you could just discuss some of the downsides of being on a long fixed rate mortgage.
Okay, yeah, I think that's a very good point you raised, right? Yeah, there are some downsides. The biggest problem with the fixed rate is there is always an early repayment charge associated with your fixed rate mortgage. Banks will say, okay, if you break the deal in the first year, if it's a 5-year deal, you generally have to pay about 5% interest. And if you break it in the second year, it's about 4% early repayment charge you have to pay. So that can be a lot of money, right? If somebody's borrowed 100,000, 5% is £5,000, right? So that's a lot of money. So that is the biggest downside you find with a fixed rate. As you mentioned, a 10-year fixed rate mortgage. Personally, I wouldn't go for that long time because a lot of things can happen in the next 10 years, right? Because I might want to move to a different area. People's needs change, right? There might be a need for schooling. There might be a need for something else. So those can change. So generally it's a little tricky to sign yourself up to a longer term deal. Of course, there are things you can do like porting and things like that. But again, it restricts you from doing a lot of things, right? So that's the biggest downside with a fixed rate mortgage. And also, fixed rate people won't benefit if the interest rate goes down. So
I was just about to say that.
Exactly, yeah. So if the Bank of England reduces the interest rate, you won't benefit from that. And likewise, if you're a discounted, that bank reduces the interest rate, you won't benefit from that. So that's the problem you have with the fixed rate mortgages. Like I said before, fixed rate mortgages are generally quite popular, right? People like certainty and they generally go for that. But of course, it has its benefits as well, yeah.
Coming to the end of this, there's just a couple more questions I wanted to talk to you about. Would you say a variable rate is good in today's times? Like, how are variable rates at the moment?
So, to be honest, this is a crystal ball sort of question, right? Because there's no right answer to this. But if you look at everything that's happening around, the Bank of England base rate is kind of all-time low. It's at 0.1%, and there's nothing much for it to drop beyond this point, right? So, given that, I'm not really sure whether it's a good idea to go for a variable rate because you benefit if the interest rate drops, right? So given that it's kind of really rock bottom, I'm not sure.
Is up.
It looks like that, right? So therefore, it may not be the right choice to go for a variable if you're expecting the interest rates to come down, right? So if the fixed rates are looking good, you probably want to go for one of them. But then again, like I said, we are now seeing a lot of discounted rates pop up. When you compare that with some of the fixed rates around, there's a 0.5% difference. But then, of course, this depends on your attitude to risk, right? if the economies take time to recover, the interest rates may remain low, right? We don't know the answer to this, right? I'm not speculating here, but if it does remain low, you may still benefit from a discounted rate. So for example, if you take a 0.5% interest rate difference, so for one half of the year, if it remains no change on the standard variable rates or the Bank of England base rates, so that means you benefited from 0.5% for 1 year. So even if the interest goes up by 1% the following year, you will still not lose anything, because what happens is you gain 0.5% this year and you lost 0.5% the following year. So therefore, you're kind of back to square one sort of thing, and you don't lose anything, right? So, in many ways, if you're getting that kind of a discount, it's probably worth looking at it. But please, you got to consult an advisor on this before you make that decision, because with a lot of these things, there isn't a one-fit-all solution, right? So it is really based on your
Very
circumstances.
individual.
Yeah, it's your individual circumstances, your plans, and a lot of things has to be factored before you make that decision. So if you're unsure, please do speak to an advisor, because that's the best thing to do.
Yeah, so what would you say, FD, to someone who's, say, paying a really high interest rate at the moment, and they're thinking about breaking their mortgage to go with a lower rate? Would that be a good idea?
Again, it depends, right? Seek advice on this one, because if you're working with a broker, you should be able to find out whether this is the best thing to do. Because if you're on a high rate, you may have an early repayment charge to pay. And likewise, if you're shifting lenders, there may be legal fees and there may be some kind of admin fee you may have to pay. Most of the time, banks...
Solicitor fees.
Yeah, solicitor fees. So those things may add up, right? So best to talk to a broker to see whether those things make sense. Because nowadays, a lot of banks like you switching from one bank to the other. So they throw free solicitors and they throw free valuations to reduce the cost to you, right? So you may just have to pay some early repayment charge. But speak to a broker, because they will know what might be best for you, right? Because it really depends on your circumstances as well. But we have seen people benefit from this, because at the moment we are finding rates less than 1% for people who have a 40% deposit, right? So if you are paying, say 2.5% interest, it may be worth looking at this option. But for people who are on a standard variable rate, knowingly or unknowingly, it's always best to consider that, because there are a lot of good interest rate deals that's going on at the moment, right? So you might be able to benefit from this,
Yeah, all right. Well, thank you again, Ifti, for some great advice.
Thank you.
I just wanted to put a reminder out there to everybody that these may or may not be applicable to all borrowers, so please do talk to an advisor if you're unsure if these points are applicable to you. If you don't have an advisor, I will leave our contact details below, as we're always happy to help here at WIS. And this is another reminder that a mortgage is secured against your home or property, and it may be repossessed if you do not keep up with the mortgage repayments. Thanks for joining us again today. We'll be back next week with another episode of Let's Talk Money and Mortgages. Have a great day, stay safe, and we'll see you again soon.